As of August 7, 2026, during active trading, Hertz Global Holdings Inc. stock is trading at $1.68, reflecting an intraday gain of 7.69% or 12 cents per share. When you see a stock bounce nearly 8% in a single session, the natural expectation is that something fundamental has suddenly turned around. Retail traders jump onto their favorite stock trading apps, scroll through social media threads, and immediately think they are witnessing the start of a massive turnaround rally. They see Hertz Global Holdings hovering down in the sub-$2 penny stock territory, remember the iconic brand name that has dominated airport terminals for generations, and assume that any positive movement is a sign of light at the end of the tunnel. But when you strip away the immediate market noise and peel back the layers of what is actually happening behind the scenes, a completely different reality emerges. This isn't a magical operational pivot or a sudden explosion in consumer demand for rental cars. What you are witnessing is a volatile reaction to high-stakes balance sheet restructuring, dilutive capital raises, and heavy institutional repositioning following their latest financial reporting. The consensus narrative around Hertz stock has long been one of nostalgic resilience. After surviving a high-profile bankruptcy during the pandemic era and emerging with what many believed was a refreshed strategy, the market expected Hertz to stabilize as travel demand rebounded. Investors who jumped in via self-investing platforms, Robinhood stock trading, or traditional Fidelity brokerage accounts believed that rental pricing power and fleet efficiency would deliver steady cash flows. But reality hit hard when the company's aggressive push into electric vehicles collided with rapid vehicle depreciation, staggering repair costs, and brutal resale value drops. The fleet strategy that was supposed to modernize Hertz turned into a multi-billion-dollar drag on earnings. What investors are grappling with right now is not whether Hertz can sell rental tickets, but whether its capital structure can survive the sheer weight of its fleet debt and operational missteps without wiping out equity holders once again. If you look at the recent trading activity, the market dynamics surrounding Hertz stock have been nothing short of chaotic. Trading volumes have spiked dramatically on days surrounding earnings announcements and debt restructuring updates. Daily swings of 5 to 10% have become standard fare for this ticker, attracting short-term day traders using SoFi Active Investing, Interactive Brokers Trading, and Robinhood fractional shares to play the volatility. Institutional activity tells a much more nuanced story. Major asset managers and institutional funds holding positions via Fidelity Wealth Management or Interactive Brokers account setups have been systematically adjusting their exposure. While some distressed value hedge funds are accumulating shares at these depressed levels, hoping for a sharp mean reversion, institutional money overall remains incredibly cautious. The heightened short interest in Hertz stock creates frequent mini-squeezes, where minor positive news or simple technical bounces trigger rapid buying as shorts cover their positions. This immediate volatility is directly tied to the financial mechanics unfolding on the corporate side. Just recently, Hertz completed a $350 million private placement of exchangeable senior first lien secured notes and priced an offering of tens of millions of new common shares to shore up liquidity. To the casual observer tracking stock quotes on an online investing site or mobile app, issuing new shares looks like a simple cash infusion, but to seasoned market participants using Schwab Intelligent Portfolios or Interactive Brokers platform analytics, equity dilution at sub-$2 levels sends a stark signal. The company needed immediate liquidity to manage its upcoming obligations and stabilize its fleet financing. When a company dilutes its existing shareholders at these prices, every existing share represents a smaller slice of any future recovery. Understanding why Hertz stock is in this situation requires looking at how its business model actually functions under the hood. At its core, Hertz Global Holdings operates as one of the world's largest vehicle rental providers, managing iconic brands including Hertz, Dollar, and Thrifty across thousands of locations globally. The revenue model appears straightforward on the surface: rent cars to business travelers, vacationers, and rideshare drivers while generating ancillary income through insurance products, GPS add-ons, and fuel charges. But in reality, a rental car company is essentially a massive, highly leveraged fleet management and used car trading desk attached to a customer service business. The profitability of Hertz does not just depend on rental rates per day or utilization metrics, it hinges critically on depreciation per unit per month. When Hertz purchases hundreds of thousands of vehicles, it must eventually sell them back into the wholesale or retail used car market through outlets like Hertz Car Sales. If used car prices drop faster than anticipated, or if the fleet consists of models that depreciate at an accelerated rate, the company suffers massive non-cash impairment charges and real cash losses upon vehicle disposal. This was precisely the trap Hertz fell into with its massive fleet bets. When resale values for used vehicles dropped sharply from their historic post-pandemic highs, Hertz found itself holding assets that were depreciating far faster than its rental income could cover. Comment below how many shares of Hertz Global Holdings you currently hold, or if you think buying deeply discounted turnaround stocks is worth the risk in today's market. Past financial reports highlight the cumulative damage of these operational friction points. Over previous quarters, Hertz reported substantial net losses driven by heavy depreciation charges and fleet restructuring costs. While total revenues remained relatively sizable in billions due to solid core travel demand, operating margins were thoroughly squeezed by high interest expenses on their vehicle-backed debt, rising labor costs, and maintenance overhead. For retail investors reviewing financial health through Fidelity mutual funds, Fidelity ETFs, or intelligent portfolio dashboards, seeing high top-line revenue paired with deep bottom-line net losses is a classic warning sign of underlying structural stress. Looking ahead, the future outlook for Hertz stock depends on a delicate balancing act between operational turnaround and financial survival. There are distinct forward-looking scenarios that could play out over coming quarters. On the bullish side, if management successfully executes its fleet right-sizing strategy, shifts back towards high-demand, lower depreciation internal combustion and hybrid vehicles, and keeps fleet utilization rates high, unit economics will improve. Reduced monthly depreciation per vehicle would instantly lift operating margins, allowing free cash flow to turn positive. In that scenario, even a modest re-rating of the stock from its current distressed levels could yield significant upside for investors who bought it pennies on the dollar through SoFi Invest, Robinhood Investments, or individual brokerage accounts. On the bearish side, the risks remain severe. High interest rates continue to make massive vehicle fleets exceptionally expensive. If macroeconomic conditions weaken and consumer travel demand softens, Hertz could face a dual hit: declining rental volume and further downward pressure on used car resale prices. Under that reality, the debt burden becomes even harder to service, potentially forcing further dilutive equity raises or additional high-yield debt offerings that burden the balance sheet for years to come. Institutional investors tracking these dynamics through Interactive Brokers' fees and platform data know that until Hertz proves its monthly unit depreciation has stabilized, the stock will continue to trade with high risk and elevated volatility. When you weigh expectation against reality, Hertz stock presents a textbook market puzzle. The market expectation often sees a legendary household brand trading at a fraction of its historical value and assumes a simple macroeconomic recovery will lift all boats. The reality, revealed through detailed analysis of fleet depreciation, debt service requirements, and ongoing share dilution, shows a company navigating a complex capital restructuring in a tight margin environment. Success will not come from brand recognition alone, but from rigorous fleet management and disciplined execution. For investors navigating these waters through self-investing, intelligent portfolios, or active trading platforms like Robinhood, SoFi, or Fidelity, Hertz stock serves as a powerful reminder that stock price movements frequently decouple from immediate operational realities. While short-term bounces offer trading opportunities, long-term stability requires fundamental debt reduction and sustainable vehicle unit economics. Understanding this distinction between market expectations and corporate reality is what separates speculative noise from true investment insight. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.